Hello and welcome to this video. In this video, we are going to do question related to manufacturing accounts from the past paper October-November 2018, variant 32. So let's start. I would like to recommend the viewers to download the question paper from one of the website given at the end of the video, as well as to do the question along with me for better understanding. In the first part of the question, we need to mention any three uses of manufacturing account. The purpose of manufacturing account has already been explained in my previous video, but let's refresh it again. Manufacturing accounts help the management of a business to calculate the total cost of production, and it also helps in deciding whether to make the product or to buy the product from an outside supplier. Furthermore, it helps in identifying and differentiating various costs like the factory cost and the office cost. In turn, it helps in evaluating the efficiency of the factory operation. Moreover, it also provides an aid in deciding about the appropriate selling price for the product. We need to mention any three uses of manufacturing account for this question. Now let's proceed to the next bit. The question gives us information about the manufacturing business like the factory profit, which is a markup of 20% and remains same for the last few years. Moreover, the gross profit margin is 40% and sales revenue is $800,000. The question also provides us the details about the provision for unrealized profit account, and we are asked to prepare the trading account section of the income statement. Let's start the solution by using the information given to calculate the various values in the working notes. The first point of the question states that the factory profit is 20% on cost for some years. We can use this information along with the information given in the fourth point about the provision for unrealized profit. With this, we can calculate the opening and the closing inventory. We can do so by using the formula provision for unrealized profit is equals to inventory at transfer price times markup percentage divided by 100 plus markup percentage. The provision for unrealized profit on 1st January is given as $10,000. If we use this information in the formula, we get $10,000 is equals to opening balance of the inventory times 20 by 120. If we take 120 to the other side and divide it by 20, we get the value of opening inventory as $60,000. Furthermore, we can use the provision for unrealized profit on December 31st, which is $12,000, to calculate the closing value of inventory using the same formula, that is the provision for unrealized profit is equals to inventory at transfer price times markup percentage divided by 100 plus markup percentage. When we do so, we get the value of closing balance of inventory as $72,000. Next, we use second and third point of the question to extract rest of the values like gross profit, which can be calculated using the formula gross profit margin is equals to gross profit divided by sales revenue times 100. Gross profit margin given in question is 40% and sales revenue is $800,000. So we get the value of gross profit as $320,000. Once we use this value of gross profit and the sales revenue value in the formula, sales revenue is equals to cost of goods sold plus gross profit, we get the value of cost of goods sold. After doing this, we calculate the cost of production using the values of cost of goods sold, opening and closing inventory. We get the value of cost of production as $492,000. After figuring out all the required information, we proceed to make the trading part of the income statement as asked in the question. We write it in the format by starting it from the sales revenue and mentioning the cost of sales and ending up with the gross profit. The next part of the question gives us information about the prime cost, work in progress, and asks us to prepare a summarized manufacturing account. For this, let's continue with the working notes before making the manufacturing account. From the previous calculation, we know the value of cost of production at transfer price is $492,000. However, when we say the value is at transfer price, it means it also includes a factory profit of 20%. So, if we assume the cost to be 100%, then $492,000 is equivalent to 120%. And as we need to find the factory profit, which is 20%, we can say that 120% is equal to $492,000. 20% how much? By cross multiplying, we find the factory profit, which is equal to $82,000. Next, we find the cost of production at cost price by excluding the factory profit. That is, we take $492,000, from which we subtract the factory profit of $82,000. We get the value as $410,000. Then we proceed to find the factory overheads, and we use the formula cost of production at cost price minus the value of work in progress minus the prime cost, and we get the value of factory overheads as $150,000. In the summarized manufacturing account, we state all the values starting with the prime cost, then factory overheads and change in work in progress to get the cost of production, to which we add the factory profit, and thus we get the value of cost of production at transferring price, which we will carry forward to the income statement. In the next part of the question, we have been given information about administrative expenses and distribution cost, and we are asked to prepare a statement to calculate the profit for the year. For this, we will make rest of the income statement, starting with the gross profit, which was calculated earlier, to which we add factory profit, which was also calculated previously, and from this we subtract the increase for unrealized profit, which was given in the question in point 4, where the account for unrealized profit was given. From there we get the value of 2000, and to this we add the other overhead expenses, that is administrative expenses and distributive expenses. Together all the overheads will be subtracted from the profit to get the net profit for the year. In the last bit of the question, we are given the information about depreciation, and it is also stated that the directors are considering to replace the old machinery with the new one. We are asked to advise about this decision. If we like to answer stating that the directors should not support the decision of buying new machinery, we can write the first 3 points given in the answer. That is, we can show the calculation of depreciation and state that the rate of depreciation is more than the decrease in the labor cost. We can also state that buying new machinery may require additional finances, and for this, if the capital is raised from different sources of finances, then an additional interest or dividend will be required to be paid. And furthermore, it can also be stated that the new machinery may require an additional training for the existing employee, which will increase the cost furthermore by adding the cost of training to the already existing cost. Hence, the overall cost will increase, so the directors should not support the decision of buying the new machinery. On the other hand, if we like to answer saying that the directors should go with the purchase decision, then we need to state the first point along with the last 2 points given in the answer. That is, first we'll show the rate of depreciation, and then we can state that as the company is using reducing balance method of depreciation, in future the overall value of depreciation will be reduced, and hence it may lead to saving in the labor cost. Furthermore, as the equipment is new, it will be more reliable and require very few repairs and maintenance cost, and it will also lead to reduction in wastage. Thus, with this, we can conclude the answer. Lastly, as I have stated in the beginning, here are the names of the few sites from where you can download the papers. So keep practicing and have a great life.